This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
On Friday, September 22nd, the Norris Group proudly presents its 10th annual award-winning black tie event, I Survived Real Estate. An incredible lineup of industry experts will join Bruce Norris to discuss perplexing industry trends, head-scratching legislation, and opportunities emerging for real estate professionals. All proceeds from the event benefit Make-A-Wish and St. Jude Children's Research Hospital. This event would not be possible without the generous help of the following platinum partners: Housing Wire, Coach Fullerton, Coldwell Banker Town & Country, Property Radar, the Apartment Owners Association, the San Diego Creative Real Estate Investors Association, Invest Club, Las Brisas Escrow, MVT Productions, Inland Empire Real Estate Investment Club, Realty 411, and White House Catering. Visit isurvivedrealestate.com for event information and tickets.
Thank you for joining us. My name is Bruce Norris, and today our special guest is John Burns. John is the CEO of John Burns Consulting Firm for real estate in Orange County. He's a consultant for many types of businesses all over the country, and he informs housing industry experts in how to make better decisions. And I have followed him for years. As a matter of fact, it was interesting to me because I just thought, John, I thought you've been around forever, and your business started in 2001, and that seems so recent to me. And welcome to our show, by the way.
Oh, you're welcome. But we met long before then, so it's been decades, I think.
Yeah, but I guess I just assumed, that people think we've been around for 40 years, and I think no, it's been 20. But in 2001, you started your consulting business.
Right, but I've really been doing this since '89 when I started with KPMG Mark.
Correct. I mean, you've done it for other companies, but I guess in 2001, say to 2006, that was an interesting time for you to have your own business and deal with what was going on at that time. First of all, who were your clients in 2001 to 2006 predominantly?
They were primarily home builders. I started the company 3 months after 9/11, which Al Gobar, if you remember Al, one of my mentors, told me was the worst time ever to start a company.
Yeah, that was a rough start for sure. But then you got to say that for the next 5 or 6 years, it's interesting. You have such a good run. Do builders think they need a consultant?
Well, we've ebbed and flowed the entire time. So back then, if you remember, nobody really could figure out what was going on in the housing market and the housing cycle, except you maybe, because you put out some pretty good reports then. So I started my business to go get that information for people and help them really run their business from a risk standpoint. And now it's completely morphed to there being too much information out there. A lot of it's bad. Hey, I don't have time to read it all. Can you go filter through it, John, and make sense of it for me? So
okay,
and our clientele has clearly changed. If I was hanging out with home builders in 2010 and 11, I would have been gone.
That's interesting to have seen your business morph into something basically because of something really bad that happened. By the end of the bull run. One of the things that you had said to me when we were talking, we were involved in you invited me into a couple of debates, and you had mentioned the difficulty of telling a builder or anybody something bad is imminent when they seem to be enjoying the present so much. So how do you impart bad news to people when it's not there yet?
That was the challenge. I think it's still a challenge. I think if you're going to be investing in real estate, you're generally optimistic in nature, because if you're a pessimist, you're just not willing to take the risk. So my clients I put them into two camps: the optimists who are making bets with their own money, and then the optimists who are making bets with other people's money.
Okay.
and the ones who are making bets with their own money, listen and really care and know about the housing cycle, most of them. The challenge is the ones who work for a publicly traded company and just want them to spend as much money as possible so they can build up a big company and have a big bonus. Those are the toughest people to talk to about the risks ahead.
We run across them all the time, as competitors. When we buy at Trustee Sales, for instance, and you're competing against $1 billion fund, and they're buying things every day that you shake your head and go home and go, that makes no sense. And you just kind of go, oh, yeah, they're on commission. That's a bad thing.
Well, and I know one of those funds was paying people per house purchased.
Yeah.
So, I mean, they had zero incentive not to outbid you. None.
Yeah, that's what it felt like, to be honest with you. I'm glad you said that, but that is what it felt like, because you kind of...
that is what was going on.
Okay, because
exactly what's going on.
When you know the numbers, you just look at it and go, okay, well, what's the plan? I mean, are they going to hold that until it goes up? Because there's no way it pencils today. But they just had... Some of it was a different game plan. When the business of buying and holding came into play, and they started buying hundreds and then thousands of homes, that was a new toy for them completely. And I would imagine that started off a whole new clientele for you.
Yeah, it did. We stumbled into that very accidentally, actually.
Well, some things like that happen. Really, that's good though.
Yeah, it's kind of an interesting story, if you don't mind me
telling it. No, I'd love to know it.
So in February 2009, a couple of months after Lehman Brothers blew up, we wrote a white paper targeted to DC people who knew nothing about housing, who now needed to know something about housing, and ran around and met with HUD and Fannie and the Treasury. I had somebody who was well connected back there who got me a lot of meetings.
Yeah, I read that this week, by the way.
One of the one of the things that came out of that meeting was really talking to Fannie and Freddie and HUD. So listen, if you foreclose on all these homes and sell them at auction, you're going to drive prices down on yourself. And you're in the business of helping people, especially HUD. Why don't you just keep people in the house, and if you're going to take the home away from them, take it away from them, but let them rent it and don't drive prices down. And they thought that was a good idea, but they're bureaucrats and couldn't really execute on it, and they wanted some capital to come in and play. So I went out and got a bunch of capital clients of mine and said, would you be interested in doing this? And they said, absolutely, yes. And those guys ended up not doing anything, but that's what got my name out there in kind of the big single-family rent out a lot of homes business. And then the smart money came in a few years later after home prices had already fallen.
Did they get in at the bottom? I guess it was my sense that they didn't, but they did.
Frankly, I think they created the bottom. So I was 2012 when most of those companies got started. I think Waypoint started a little earlier than that. But when Blackstone, which we picked up very early on in their decision, started buying, we got a lot of confidence that the floor was in because they were going to create it. I mean, they almost had enough money to create it themselves. And then Tom Barrick from Colony came along and started doing it, and Barry Sternlicht from Starwood. And these are some guys who can raise a lot of money. And it became pretty clear the bottom was in, not because the economy was turning around, but because these guys were going to do exactly what they did to you on the auction steps, Bruce. Good job.
Yeah, because they had a different formula. Their formula was, does it make sense if we hold it and collect rent? Not do we have to resell it tomorrow? Yeah.
Well, their formula at the time really was buying below replacement cost. They were all clients of mine. That was it. I'm distressed buyers of real estate, and buying homes below replacement cost is my game. And then we had a big debate on what replacement cost meant, and we never really all got on the same page there, but that was the investment thesis.
What is the difference? Okay, I know your clientele, you have private equity and then you have institutional investors. So what's the difference between those two, and do they have different end games?
Yeah, so I use the term institutional investors to refer to people that are trading securities, and the private equity guys that are making much less liquid investments generally in companies and buying homes and those sorts of things.
Okay.
And there are companies that do both, but they're different buckets of capital.
The institutional...
So the Blackstone, Colony, all of them, they were private equity funds.
Okay.
But now that they are publicly traded companies, they've essentially cashed out all their private equity investors and have now now are traded on the stock market. It's a different type of owner of the company now.
I think that's what I was kind of getting to, and it's really not a world I understand really well, because I get a lot of questions as I speak. Are we afraid about all of these large holding companies selling all their stuff at one time? And I don't think that's their end game. And I think maybe what you just said is they've already changed their position in a way that they don't.
Well, they can't.
They can't.
They can't.
That's what I thought.
Yeah. So they are publicly traded companies who have loans secured by the income on those assets. They are prohibited from selling off more than a certain percentage of those. And they're all REITs too. So
That's
actually,
right.
I don't know the exact REIT laws, but if you sell more than a certain percentage of your assets every year, you lose the REIT tax benefit. So I think it's the non-publicly traded guys that you need to worry about, not the publicly traded ones.
Okay, that makes perfect sense to me, that they're going to be holding those. Now, have they switched their emphasis from ownership of rentals to doing loans? Is that a new toy?
No, not for those guys, no.
Different group entirely?
Yeah. Oh, you know what? I should take that back. I mean, Blackstone has a group called B2R. Cerberus has one called they've got affiliated groups that are making loans. You're correct.
Okay.
But it's a different bucket of capital, and probably raised by the same guys, but different investors.
Okay. In general, this is their first big investment in rental real estate. That to me, I had never seen that before. Is that something that is a new toy that will at some point discontinue, or do you think that's a pretty permanent piece of the landscape at this point?
Oh, I'm very convinced it's a permanent piece of the landscape.
Okay.
I mean, they're publicly traded companies now. They've got rated bonds. You can look at their financials. They're making money, and they're only 4 or 5 years old. So there's a lot of fine-tuning of operations, I think, and they've told me a lot of low-hanging fruit inside their own business just to get more efficient. And then to do ancillary services just like the apartment guys do. They'll sell landscaping services and probably cable packages and all sorts of things.
Okay. John, in areas like Palmdale, Lancaster, Victorville, Menifee, Hemet, used to, during these boom cycles, they would just be cranking out new homes. And when I look at the charts, that just hasn't happened yet. So what's your take on what's next for those types of areas?
I think those areas are going to have their day. It's just going to take a long time. I mean, the recession we just went through was massive, and the recovery has been slow. And, we wrote a book about the demographics and how big the millennial generation is. They're just getting started much later because of the economy and other factors. And the other thing I don't think people have really focused on is the last 20 years, there's been virtually no infrastructure investment in improving freeways. Now, they just did something on I-15, but that's really the only investment I can think of. So the traffic has gotten horrendous, and society has shifted away from the importance of owning something really cool and maybe commuting because I want to own something cool to more valuing my time and experiences. So people just want to live closer. And I still think those outlying areas are going to come back, though, Bruce, because I've seen them come back in the economies that have recovered stronger than ours. I mean, Texas, Denver, people are Atlanta, people are driving and the freeways are,
There's a mental shift that happens when you have really aggressive price increases, too. What you're willing to say yes to, if a lender's willing to loan you money, we found out people will say yes to ridiculous payments, but they'll also say yes to exaggerated other categories such as driving time. So when we built the 93 houses in Rosamond, which is 9 miles outside of Lancaster, sort of feels like you're in the middle of nowhere. 90% of our buyers worked in L.A., and that was a drive that was going to be acceptable to them because they had a chance to get their name on a grant deed. John, in your book, Big Shifts Ahead, which by the way, I really enjoyed, it's probably the most marked up book I've ever owned in my life. I read it in a day, which is hard to do, but I was pretty excited about it, and I thought it was kind of a breakthrough work, and I hope you've had great success with it, to be honest with you.
Well, thanks, Bruce. That's a big compliment, and we've had a lot of nice compliments, so it's been good for our business.
The one thing that you say is coming is a decline in ownership, and so that's a really interesting thing to me because there's there's other things that will happen if that occurs, And so as part of what I wanted to talk to you about is, do we have a current group of young adults that are capable but just aren't interested, or for some reason are they not capable of getting a yes answer in this environment, the lending environment that we have right now?
I think they're far more capable of getting a yes answer than most people think, than the media thinks. There's so much media running around saying the mortgage industry is too tight, and the documentation is extremely tight. But if you've got a job with a W-2 and you can scrape together a 3.5% down payment for the median priced home in the market, you're in. And that's actually, if you go back decades, that's historically loose. So I don't think that's the issue. I think the issue that most people miss is the very high homeownership rate amongst people born in the 1940s and 1950s and then 1930s too, who are starting to pass away. And we're going to lose 16 million homeowners over the next 10 years. Those people have an 80% homeownership rate, and it's going to take a lot to replace that. And we've done the math. I think it would be, you would almost need something like a GI Bill to prevent the math that I'm talking about from happening. Homeownership is going to trend down unless we make it really, really easy for people.
Which is a very interesting question, to be honest with you. So what you're saying is the math is inevitable. You've got people that are turning from 65 to 85, which eventually, and I'm in that group, starting November 11th, who eventually won't be here, and they're the group that owns 85% of the time, being replaced by a group that owns, somewhat less than that, being replaced by a group that owns somewhat less than that. So the math is there unless this new group can own at a really brisk pace. And what you're saying is that if you want that to happen, we have to create some special circumstance of financing. Do you think there's any willingness to do that?
Well, there could be. I don't think any administration, or Democrat or Republican, wants to see falling home ownership on their watch. So there could be. But I think these young folks are going to achieve roughly about 5% lower home ownership rate than their parents did at the same age, is my math. So they're still, say, by the age of 65, they'll still get to 75% home ownership, which is quite high. It's just not the 80 of their parents. And I think that's the shift. And I actually think I'm being pretty aggressive there when I say getting to 75, because that's a pretty high number. This prior generation had the GI Bill to help them out.
Correct. Now the GI Bill, that's for veterans, right? That still exists, right?
Yeah. Well, they were all veterans.
Oh, they were all veterans. Okay, that's true. Much higher percentage of them. Are you against a nothing down loan program that has nothing to do with being a veteran, but has to do with how they qualify, how VA qualifies people, because they have a very successful loan program with nothing down.
They really do, and but they underwrite very tightly and dot every I and cross every T, and there must be something about people in the military who are more likely to honor their mortgage payment than others. It's amazing to me how well the VA fared during the downturn compared to other loan programs.
Yeah. So you think it's more who they lend to than the process, maybe, or at least part of it anyway?
I think that's part of it. And then plus if that person was in the military right now, they didn't lose their job. So the biggest reason for foreclosures is job loss. Okay.
What do you think of any tax law changes that might affect ownership interest, let's say? I mean interest deduction, but interest in owning it. If you take away the interest deduction, all of a sudden you go, well, doesn't matter too much if I own or not.
I think that's already become far less important, and that sounds a little crazy for a guy who lives on the coast in California. But we rarely hear the mortgage interest deduction being the reason people are buying now, and that is different than 20 or 30 years ago. So the standard deduction for a couple now is north of I think it's $12,600. So you need to get to $12,600 in itemized deductions before you see any tax benefit at all. So, okay, in coastal California, somebody buying an $800,000 home is going to get that, but in most of the country, there's really very little interest to be deducted. And I saw a piece in the LA Times this week, I forget who did it, about the mortgage interest deduction going from $1 million down to $500,000 maybe as the cap would only impact 2.4% of households in California, and it would project or impact far a lower percentage than that nationally. So it's a long-winded way of me saying I don't think there's a lot of it's not the sacred deduction,
the Holy Grail
that it used to be. It's not.
Okay.
It's not. You go to the Heart Belt and you go. Nobody's deducting interest because you got to get a $500,000 mortgage to do that, and they're not getting that big of a mortgage.
Well, too, if one of the tax law changes that might be implemented is to raise the standard deduction, that would take out most people.
Right.
So,
yeah, and they're talking about raising it to $24,000. There'd be no mortgage interest deduction.
Well, so, thinking about some other unintended consequences, when you retire, there's a very big difference financially if you own a home and if you don't. So that's right. One of the things that's going to occur with your math is that you're going to have, closing in on 40% of people not owning a home and not building that. So is that something that you've considered, and you've talked about some of these people that make decisions and say, the outcome there is not going to be pleasant for those people?
No, I think you're right. But the math on the 60%, is it would be about 75% amongst people hitting retirement age,
retired, okay,
and about 40% amongst people, in their early 30s and 40s.
Okay.
So it's not 40% of retirees renting.
I got you.
But it is a higher percentage than today. Well, and that's the whole policy argument is homeownership has been a great savings account for retirees, and I totally agree.
The other thing it does is it fixes a payment to where I think over time, that's, as people make more and more money. They have more spendable income. If you rent and you're a landlord, landlords check that number every year, right, to bump it to where that's always taking a bigger and bigger chunk of their money. So it's a bill they never get away from, and it never diminishes in percentage if you don't own.
No, you're totally right. But the number of single parent households now is very high.
Yeah,
it's just really hard for people to save a down payment, and most of my home builder clients tell me that's the issue these days. It's not the mortgage payment, it's not the FICO score, it's the down payment. Even the 3.5%.
Right. See, that's why
it's really hard for people.
See, that's why it seems to me a no-brainer. Take the risk. Do a nothing down loan program with two caveats. I'll get on my box here for a minute. Why not do a loan program, Fannie Mae, nothing down, with two additional features? The loan can be taken over subject to simple assumption as it used to be by anybody that makes the payment current. And if it actually goes to a trustee sale, the opening bid is the payment. The payment's missed, not anything to do with the loan balance. I would imagine you'd have virtually no foreclosures in that program that would end up being an REO that would lose the bank money.
Well, you should propose that. I proposed the assumable loan 15 years ago, and actually E-Trade, which had a mortgage program, rolled it out. And because it was assumable, the bond market assumed that it wasn't like a 10-year maturity. It was more like a 30-year maturity.
Okay. Which
has a 50 basis point higher interest rate associated with it. And nobody opted for it because nobody wanted to pay 50 basis points higher, even with the great program you just outlined. Well, the consumer just said, I'll take the lower interest rate.
Yeah, they need to understand it better, I think. John, we've run out of time. I really want to thank you for being part of our September 22nd event, but I appreciate you taking time to do that.
The Norris Group would like to thank its gold sponsors for supporting I Survived Real Estate. First Lending Solutions, Guaranteed Rate and Nathan Chaboya, In a Day Development, Inland Valley Association of Realtors, Jennifer Buys Houses, Keller Williams Corona, Keystone CPA, LA South RIA, Michael Ryan, New Western, North San Diego Real Estate Investors, Northern California Real Estate Investors Association, Orange County Investment Club, Pacific Premier Bank, Pasadena Phoebe, Pilot Limousine, Real Wealth Network, Rick and Leanne Rossiter, the San Jose Real Estate Investors Association, San Francisco Bay Real Estate Networking Summit, Sunoco Corporation, South Orange County Real Estate Club, Spinnaker Loans, Think Realty, U Direct IRA Services, West and South Coast Plaza, Wilson Investment Properties Inc., See isurvivedrealestate.com for event information.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.